All right, ladies and gentlemen, I hope you had a wonderful day. The market streak continued once again, and now 13 of the last 14 trading days are green. But today we got to go a little bit broader and talk about Wall Street's bullish mistake. So I got a couple of things cooked up for you. We got to go over where the market is in relation to some other points in the past. Then I got the balance sheets and interest expense, but then the real big thing we're going to start with is this new thing called synthetic risk. It's actually not really that old. This should sound very familiar, but why I'm so excited to make this video, because it gives me a chance to break out the camera now, and I get to show you these little, cool little, look at, they're little baby gold coins, but hopefully it helps you understand what we are going to be talking about here. So let me go back to the computer. You could see this Wall Street Journal article. This has been something that has been talked about recently, and this article really got people's attention, and they got it behind a paywall, so unfortunately I will recap it for you, but if you go look back, there is other articles that have been talking about this synthetic risk transfer. That is what it's called. And like I said, in European banks, it is very common. But if you go through, you have been hearing about this lately, but it's not like it gets the crazy amount of coverage. So I want you to understand it. But while we're here on the computer, before I get into any of the gold coins, I really think this chart can help you understand what's going on with it, because it's kind of confusing. That's why I did break out the gold coins to give you a visual, but even then you'll see it is quite the interesting contraption that Wall Street has came up with, and I'll tell you why it is both bullish and bearish at the same time. So what is a synthetic risk transfer? You are transferring risk from one person to another, but it's synthetic. What makes it synthetic or fake is that the bank keeps the credit and they're giving you an option on a portion of the debt. So as you see here on this chart, Citi, they gave out a loan of $500 million. They are choosing to sell off around $60 million as a note for investors to buy. So why in the world would they want to do this? Because the banks get cash up front and the investors are getting a note and they get interest in return. So what ends up happening is that it's insurance for the bank on loans that they already made. So instead of paying an insurance premium, they pretty much pay interest. It allows it to be cheaper for them in the long run. And why banks are doing this now is to free up capital. A lot of banks are trying to meet capital requirements. Like I told you, the European banks, this is more normal for them. Since post '08, a lot more European banks have been doing this, and now after the Basel III requirements and they need more higher capital requirements, this type of synthetic risk, it's leaving the bank holding the loans they've already given out. It's giving them a cash infusion, and instead of reworking the debt, selling it, by making it a note and paying out interest, it's way easier, and now they have a guarantee on some of their debt. So it's very much like a collateralized loan in the CLOs of '08. So now we could get into the coins and you could see here is the original loan. Like I showed you on that Citi example, this is a $500 million loan that they already gave. So if you split it up into parts, 10% of it, that's 10 little coins. But here, I got to make this even there. I'm looking at the screen. It's getting very, you know what I'm saying? I'm not looking at, I got to look at the coins and not the screen. Anyways, but this portion, 10% of the entire loan, investors are giving the bank cash. What do they get in return? Interest on this portion. But now here's the funny part. Nothing is moving. This is why it's synthetic. And this is why I was like, I'm even going to have trouble showing you with these coins, because the bank still keeps the loan. They already gave the money. All they're doing is getting back cash. So now they keep the investment. I was trying to work it. You could even cash. You even take the 10%. They still own everything. What ends up happening is that if this loan goes bust, right, then this coin disappears. That 10% that the investors wanted to put up, remember, they put up their cash. Well, they lose it because that loan did not perform, and then the bank keeps this. That's why it's a capital buffer for them. So that's a way to look at it. Again, it's just Wall Street doing Wall Street complex things that make sense and not really, but this is why I'm saying it could be a bullish mistake, because one, if this starts to come around, and what we're noticing is that there's a pickup in these deals in America, even though it's been Europe, it's crazy. Even go to the Fed website, they have a FAQ on this because now the Fed, about a year ago, the Fed said, no, we're not going to approve these. It's too risky. But now the Fed is saying we'll take it on a case-by-case basis. But why I'm saying it's bullish, because this is going to free up a lot of capital. Essentially, you know how I have investors running, chasing this yield, even though we're in a high yield environment. This is even higher, but it's giving a bunch of capital infusion to these banks on loans that they already made. So that's just bullish. Is there anything bad about that? No, not really. Really, the only problem that emerges from here is that if it leads to rampant, excessive, speculative behavior, or even worse, if these banks pull a Billy Huang, and then I guess we got to go back here to the gold coins. What would be wrong with that is if they took this same, gold coin, this 10% of the debt, but instead of, doing this little setup every time, they just took this one coin and just sold it over and over and over again. So then that way, if one went bad, it would infect all of it. I don't know. Yeah, I don't have Selena Gomez to show you, okay? That's why you got to subscribe and support the channel, man. All right, man, we do it free 99, youtube.com/the stock market. We're live too. Did I tell you that? I don't know. Anyways, but the overall point is it's very interesting, but now especially in the short term, maybe this opens up some of that runway for the people. I shouldn't even call it a runway, for the people who want the soft landing. Again, banks have been struggling. We've been worried about rates and everything going on, but if you see the emergence of this type of capital structure and these banks finding ways to turn old bad loans and at 10% at a time to generate cash, we should be worried if it leads to rampant risk, but in the short term, that could give them a lot of capital relief or help these banks, which is the reason why they're doing it, meet these new and higher and harder, tougher, stiffer capital requirements being imposed on the banks. So thought this was very interesting. I wanted to make a video on it, but now it just ties into so many things. So like I'm saying, the bullish mistake, the lag, and everything else, I have to bring up the second thing now, and that is the interest expense. So it kind of relates to everything going on here because, again, we've seen how the market's been reacting to a host of different things, but lately it has been interest rates. And from 2 years ago till now, what has been the freak out with interest rates? Quite simply, everybody has been worried that, oh my gosh, high interest rates is going to destroy the economy. How can these companies that lived in zero interest rates, how will they ever survive? Well, fast forward almost 5.5% later, in the shortest amount of time, the economy seems to be doing okay. We've had a crazy high GDP. Stock market is still hovering near all-time highs, and quite frankly, 4%, 2, 3, whatever percent didn't kill us, and a lot of people were worried, especially after being at zero for such time. So why didn't we die? And the answer to that is interest expense. A lot of people realized this not too long ago, some almost a year ago. We've talked about it, but I'm glad I could put it into this video because, again, we are talking about bullish mistakes. And if you haven't noticed, there's an inherent lag behind everything I'm saying. With the synthetic risk transfers, it's going to create liquidity. There's a lag for the consequences. Again, rates, they happen. People got worried. Even though we've had the rates go up, there's still a lag on the consequences. And even after this, I'm going to show you one more thing, but coming to this interest in what has gone on, how come the market and things didn't die when interest rates went up to 5? Why did everybody buy tech stocks? Well, it's because over the years when rates were so low, not every company took out a massive amount of debt. So what I'm showing you here, this is just a balance sheet, and you'll see interest expense. And if you go through the years in the quarter, you could see how much a company is paying in interest. So what usually happens is that when rates go up, TLT drops, and interest money becomes more expensive, usually companies have to pay more in interest. But the phenomena that we have noticed over the last couple of years, some companies either didn't take out a lot of debt, or when they did, they took it out at such low interest rates that even though rates went up really high, really fast, it's not like they're having an effect. It's not like the past and the cycles of the 90s, 80s, 70s, wherever when interest rate went up, where companies now would get less profits because their profits were getting eaten up by interest. That is not happening. The company I'm showing you right now is Amazon, and that's what you could see here. Go back to even 2020, rates were still zero here, but you'll notice how much they're paying, from 11 million to 30 to 20 to 10, even the latest quarter, 39 million in interest. This is not a large number. It's not going up, and compare that to the backdrop of what they're bringing in, their cash and everything else. So this is very important, but now where's the contrary? There's some companies out there, and this is those lagged effects where why is everything not dying immediately? Because it's not like interest rates. It's not a haymaker. The interest rate is a jab, and it's like pop, 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 but you open up a lot of things with the jab, and that's what's happening. So this company right here, I'll tell you which one it is afterwards, but you could take notice. Their interest expense right now, $73 million, or the quarter before 63, the quarter before 51, and you'll notice what has been the trend as rates have gone up. Their interest is skyrocketing, right? And you'll even see from December 2021, 17 million to 70. That's a lot, but let's go way back, and let's go back to when rates were very, very low. And this company right here, you'll even see from June 2020, I went back even further to 2019. I think you could even go back. I went to the other one. You could go back all the way to 2018 here, but they were paying as little as $6 million in interest expense at one point. Fast forward to today, and again, quarter over quarter, you're seeing, the roosters coming home to roost, and you have to pay interest now, but that's almost 10 times what they were paying just a couple years ago. This is usually what happens, but unfortunately, some of the biggest companies in the world, they weren't like this. I don't know why I said unfortunately. That's if you want to see the market go down, but fortunately for the state of the economy, pal, anything else, well, that's helping out things, but there is names, and now this company, this is a firm. So they rely on interest and funding, and you're seeing their interest costs are coming up. Not only are they paying back their debt as well, too, but their interest is starting to eat. Now, some companies will survive, some won't. It all depends on the growth and everything else, but this is to speak of these bullish mistakes that we keep on making. We keep seeing something as this. We're like, okay, well, it's good. Well, no, it's just going to take some time. So there's that part. And now finally, I guess to culminate it, this should make sense why I'm ending with it, because this is what people are talking about. Is where we're at right now, and whether or not soft landing, if we actually pull it off. If you guys don't realize what is really happening, we are almost entering into the final stage. I've showed you the funny part about this chart. This is showing you the NASDAQ 1999 versus where we're at now, and this has got people asking a lot of questions, even getting excited, but the thing about this, we talked about this with the bonds. It's not really about the market repeating the 2000s. That's why I'm saying you'll notice we were talking about this on the bonds before people are bringing that up on the market. And sure enough, you could see there was two different experiences. Now, in both instances, the market rallied up and then eventually came down, and there was a lot of things that happened, but why do I bring up those moments? If we're going to look at the market and compare it to 1999 or 2006 now, based on how it's moving, what's the reasoning? It was based off of the Fed hiking or pausing, this whole cycle coming into an end. Remember, it was in March or May 2006 where they paused. About 18 months later, they ended up cutting, and you saw how interest rates performed. In 1999, they did one of the stop-and-go pauses like we did, and we talked about that happening, and sure enough, we played out very similar to that. So why I'm bringing this up, how does this have to do with this chart in the final stage? Because we are at the final stage now. If this really does, there is the potential of a pump fake. But again, Powell has indeed stopped now, and we're entering in now months and months at a time of the Fed not moving. That is all the more going to cement the idea. But the next stage now is ending the cycle. And that is either going to end by not going up until we cut, or they want to cut it and say, okay, we're done now. Now we could cut. But you know how I feel about that. I think that's overall negative. But in general now, this is the final run now. And like I'm saying, Wall Street's bullish mistake, it's just the lags. That's all. And there's things, and now looking at how banks might come up with things to add liquidity. We're watching interest, and some companies get affected, some aren't. What the hell is happening there? But hopefully you get what I'm trying to show you here. In general now, we are entering into the final approach to really find out if we stick the soft landing, no landing, hard landing, or we run into turbulence right at the end. But it's starting to get really good. So, Chad, I hope you enjoy this video. It's a little different than your normal watch list, but like I said, the market, very simple here over the last couple of days. I'm expecting somewhat of a breather. We got a little bit of data tomorrow, a bond auction next week. I'll give you the breakdown over the weekend, but Chad, I hope you enjoy it. I hope I see you in the morning. But that is your watch list, and good evening, good morning, good night. Okay, I'm out. Horn. It's not that awkward. Horn.